Hello investors, myself Siddharth Mandlewala, fund manager at Concept Securities. Here I will be discussing outlook on economy and equity market. First of all, I would like to give you a highlight on global equity market. US is recovering. US GDP growth is predicted at 2.5% this fiscal. Other economies are not doing that well as compared to US. At the same time, the quantitative easing which was going on till date, in the last speech of Mr. Ben Bernanke, the Fed chief, he said that quantitative easing will start gradually tapering off. This has created a panic like situation across all the economies and over all the asset classes. We have seen a sharp correction in equity market and in currencies across the world. I think that quantitative easing tapering off is negative for short term, but it is positive if we look at medium to long term, as it will help prevent asset bubbles. Now coming to Indian economy, I would like to highlight a few points. First, if we discuss the past of India, in last 30 years, India has grown at 60 times. India's GDP has grown 60 times in last 30 years. In last 10 years, India's GDP has grown by 4 times. So this is a phenomenal growth. If we discuss the next 5 years, then per capita income of an individual in India is currently at $1,500 to $1,600, which will rise to $4,000 to $5,000 in coming 5 to 6 years. So this is very positive. And if we look at other countries who had $5,000 per capita income and see the explosion of consumption in that country. So we are going to see that type of a consumption boom in India also. Also, India has an inherent strength of demographic dividend. We have 50% population which is below the age of 25, a young population, a consuming population whose income is rising. So this is again a very positive point. The other important point which I would like to highlight is that India is a democratic country. Now, I would like to discuss some sectors which can give you good returns in coming future. If we discuss again the past, then India has always witnessed 8-year cycles. So from 1993, during Harshad Mehta scam, cement stocks were given a huge premium. I still remember that cement stocks were trading at 4 to 5 times replacement cost during that era. So it was a boom time for cement stocks. After that 8 years, there was an IT boom in 1999-2000, where IT stocks were trading at above 100 PE ratio, which was phenomenal, which was euphoric, I would say. Then after 8 years, we had another cycle which was of infrastructure and real estate. Here again, PE ratios went through the roof and gave phenomenal returns. After 2008, after Lehman Brothers crisis, again a new set of stocks have come up, and that is consumer stocks. So we think that consumer as a theme should continue to deliver over next 1 or 2 years also. We are very bullish on FMCG, pharma, media. These are the sectors which are related to consumption. Now, India is looking very promising because in last 6 months, many reforms have come through. After the appointment of Mr. P. Chidambaram, our finance minister, he has given very good reforms such as FDI in retail, FDI in aviation. Then there is a partial deregulation of diesel, and there is full deregulation of petrol. So this is very good step taken by him. So again, if we see Indian economy, even our inflation has started to come down. It has come down to 43-month low, and so its effect is seen on the interest rates, which has also started to come down gradually. Talking about valuations, I think valuations are also very attractive and reasonable. This year we are expecting earning per share of Sensex companies, that is Sensex 30 companies, to be around 1310, and currently Sensex is trading at 18,500. So PE ratio comes to around 14, and our historical average is around 16. So we are trading at a discount to our historical average. So once our economy turns up, we will see a gradual re-rating of our PE. So my final advice to the investor is, in last 5 years we have seen very good returns in real estate sector, in precious metals, gold, silver, real estate. These all asset classes have given you very good return. But equity is at the same level. In 2008 Sensex was 21,000, today it is at 18,500. Although the earnings have gone up, earnings was 800 and it has gone up to 1300. So I think the best of returns in real estate and gold is behind us, and best of returns in equity market is ahead of us. So I feel that investors should skew their portfolio and become overweight on equities in coming 1 or 2 years, because in next 5 years you are going to gain much more in equity than compared to any other asset class. Thank you.